Have you noticed the media suddenly singing a different tune on the economy?
George Gammon, the founder of Rebel Capitalist, is here to break down why.
In this video, we've distilled George's hours of analysis into just minutes, so let's get started.
George explains the possible factors behind the shift in media sentiment. A quick reminder, this content is for educational purposes only and is not investment advice.
Today, we're dissecting the latest shifts in market sentiment with insights from George Gammon of Rebel Capitalist.
George, a known contrarian, isn't shy about calling out media narratives and digging deeper into what's really driving market moves.
George's analysis cuts through the noise and offers a different perspective on economic trends, market risks, and investment strategies.
Exactly. So let's dive into what George has to say about why the media is suddenly changing its tune and what it means for your investments.
George Gammon points out that the media's tone on economic and market conditions has recently shifted, becoming more optimistic.
Right? George is highlighting that earlier warnings about potential downturns are now replaced with more positive forecasts.
George notes that this change in narrative could be influenced by various factors, including political pressure, economic data manipulation, or genuine improvements.
Yeah, George suggests that there might be underlying factors driving this shift.
George believes that understanding the manipulation by the powers that be is crucial.
Agreed. It's time to stop taking everything we are told at face value.
According to George Gammon, if you want to understand where inflation is going, you need to know where the manipulation has occurred.
Yeah, George believes that monetary policy shifts are essential for understanding the current economic landscape.
George Gammon warns that the current positive market outlook could be misleading, setting the stage for a potential correction.
Yeah, George suspects that the market's optimism could be overly reliant on continued stimulus measures and low rates, creating a fragile situation.
George believes a shift to a tighter monetary policy could trigger a significant market pullback, catching many investors off guard.
Absolutely. George notes that careful planning is essential during times of great uncertainty.
George Gammon says the key is to stay informed and adapt quickly to changing market conditions.
Right? George emphasizes that understanding monetary policy and its effects is critical.
George also suggests watching for shifts in consumer behavior and spending.
Yes, George believes that changes in consumer habits can signal broader economic trends.
All right, today we're diving into the Texas housing market. Specifically, we are reviewing Nick Gurley's analysis on why home builders are slashing prices.
Yeah, Nick paints a pretty dramatic picture. Apparently, builders are liquidating inventory like it's Black Friday.
So, what's driving this fire sale?
According to Nick's video, several factors are at play. Rising inventory, slowing sales, and builders trying to unload properties before things get worse.
In a nutshell, Nick Gurley's thesis is that the Texas housing market is experiencing a major correction. Builders are overstocked, sales are down, and prices are getting slashed.
Yep, it's a buyer's market, plain and simple.
So it's a great time to be a home buyer in Texas.
Potentially, but Nick cautions that buyers should do their homework and negotiate aggressively. There are deals to be had, but you need to know where to look.
First up, Nick Gurley points out that housing inventory in Texas is exploding. We're talking a massive increase in the number of homes for sale.
Yeah, months of supply is way up. Builders can't sell them fast enough.
So what areas are seeing the biggest jump in inventory?
Nick highlights specific markets like Austin and Dallas, where the supply of new homes has ballooned.
So it's not just a statewide trend, it's concentrated in specific hot markets.
Exactly, and that localized glut is putting even more pressure on prices.
Okay, so inventory is up. What about demand? Is anyone actually buying these houses?
According to Nick, sales have slowed considerably. Homes are sitting on the market longer, and fewer people are making offers.
So, is this just a seasonal dip, or is something bigger happening?
Nick suggests it's more than just seasonal. Rising interest rates and economic uncertainty are scaring off potential buyers.
Ah, the classic double whammy of higher costs and shaky confidence.
Exactly. And that's forcing builders to get creative with incentives.
So, builders are feeling the pressure. What are they doing about it?
Nick Gurley highlights that they're slashing prices left and right, We're talking discounts of up to 20% in some cases.
Wow, 20%? That's a pretty significant markdown.
Yep, and it's not just price cuts. Nick also mentions builders offering incentives like free upgrades and mortgage rate buy-downs.
So they're throwing everything at the wall to see what sticks.
Pretty much, they need to move these houses, and they're willing to negotiate.
So, where does Nick Gurley see the Texas housing market heading from here?
He suggests that prices could decline further, especially if inventory continues to rise and sales remain sluggish.
But what if interest rates start to fall? Could that turn things around?
Potentially, but Nick points out that even with lower rates, the market still needs to absorb all that existing inventory.
So it's a waiting game to see how quickly buyers return to the market.
Exactly. And until demand picks up, expect builders to keep offering deals.
So, what are the main takeaways from Nick Gurley's analysis for potential home buyers?
First, keep an eye on inventory levels in Texas. Nick highlighted that builders are eager to sell, leading to some sweet deals.
And what data sets should they be watching?
Definitely track the median sales price and months of supply in key Texas markets. If months of supply keeps rising, expect further price cuts.
Today, we're breaking down Target's recent warning about the U.S. economy with insights from Jeff Snyder of Eurodollar University.
Jeff has been spot on with his analysis of economic trends, so when he talks, people listen. We're going to dive into his key points to see what's really happening.
Target's warning has sent shockwaves through Wall Street. What exactly did they say?
Well, Target flagged rising inventory levels, supply chain issues, and softening consumer demand. Pretty much a trifecta of bad news.
Jeff Snyder argues that Target's recent warning about the U.S. economy is more than just a company-specific problem. He sees it as a sign of deeper economic issues.
Jeff's take is pretty grim. He thinks Target is just the first domino to fall and more pain is coming.
Jeff suggests that consumer demand is weakening and retailers are struggling to manage excess inventory.
Basically, people aren't buying as much stuff and stores are stuck with warehouses full of unsold goods. Not a great combo.
Jeff Snyder points out that Target's increasing inventory is a major concern. Why is that?
Think about it. Stores are stocked with stuff people aren't buying. It screams demand is dropping faster than expected.
So it's like a retail traffic jam.
Exactly. And retailers might have to slash prices just to clear the shelves. Get ready for some sales.
Jeff emphasizes that high inventory could lead to price cuts and reduced profit margins for retailers.
That's right. It's a race to the bottom as retailers try to offload excess goods.
Jeff Snyder suggests that Target's warning could signal a broader economic slowdown on the horizon. What's his reasoning?
Basically, Target is a bellwether for consumer spending. If they are hurting, chances are other retailers are too. It could be the canary in the coal mine.
So one retailer's problem could snowball into a nationwide issue.
Bingo! A drop in consumer spending can trigger a cascade of negative effects throughout the economy.
Jeff believes the Federal Reserve's interest rate hikes could exacerbate the situation.
Exactly. Higher rates cool down the economy, but they also increase borrowing costs for businesses and consumers.
So it's like hitting the brakes too hard.
Precisely. The Fed is trying to combat inflation, but they risk sending the economy into a recession.
Jeff Snyder emphasizes watching inventory levels closely. A buildup could signal weakening demand.
Yeah, if Target's shelves are overflowing, it's not a good sign for the economy.
Jeff also suggests keeping an eye on consumer spending data. Any signs of pullback would confirm his concerns.
So if people start cutting back on lattes, we know things are getting real.
Today, we're diving into Jim Bianco's analysis on the potential for a market crash. Jim is a renowned market strategist known for his insightful takes.
Yeah, David Lin's interview with Jim covered a lot of ground. Let's break down some key points, starting with the Fed's potential role in all this.
So what were the main takeaways from Jim Bianco's analysis and David Lin's discussion?
Jim sees the Fed's actions as central to market stability. Their decisions on interest rates and quantitative tightening will have huge impacts.
Essentially, the Fed is driving the bus.
Pretty much, and as Jim noted, the road ahead is full of potholes.
Jim points out that the Fed is in a tough spot. How so?
According to Jim, they're trying to balance controlling inflation with avoiding a recession. A classic tightrope walk.
So either they raise rates too much and crash the economy, or they don't raise them enough and inflation runs wild.
Exactly. It's a lose-lose scenario if they miscalculate.
And what about the impact on markets?
Jim thinks that Fed policy is a major catalyst for market volatility. Any unexpected moves could trigger significant sell-offs.
Sounds like investors should buckle up for a bumpy ride.
Definitely. And according to Jim Bianco, keeping a close eye on the yield curve will be important.
So, what's Jim's outlook on the market's future?
Well, Jim anticipates potential for significant market corrections. He emphasized that high valuations make markets vulnerable.
Meaning what exactly?
If earnings don't keep pace with stock prices, we could see a sharp decline. Also, Jim stresses the importance of monitoring corporate earnings.
And what's the worst-case scenario?
Jim didn't rule out the possibility of a full-blown economic crash if the Fed mismanages its policies.
Yikes. So what can investors do to prepare?
Jim suggests having a plan in place to manage risk. Diversifying assets and staying informed is key.
So, what should investors be watching based on Jim Bianco's analysis?
Definitely keep an eye on the Fed's actions. Jim stressed how their decisions will dictate market direction.
And what else?
Be aware of the potential for increased volatility. According to Jim, surprises are likely.
Today, we're diving into the predictions of Michael Pento, Pento, an economist known for his bearish views on stocks and real estate.
Michael Pento has a track record of calling out market bubbles, so let's see what he's warning about now.
And we also want to examine Adam Taggart's analysis, given his experience with investments.
Adam Taggart brings a lot of practical wisdom as well to understanding what all this means to the average person.
Michael Pento believes that the drying up of liquidity will cause significant drops in both stock and home prices.
He's predicting a double whammy, folks.
He is claiming stocks and home prices to fall by 40 to 50%. Does Adam Taggart agree?
Adam Taggart, is also concerned with the effects and advises viewers to be prudent.
Michael Pento predicts a substantial correction in equity markets.
He's forecasting a 40 to 50% drop? That's pretty scary. Why so bearish?
Michael Pento believes the Fed's liquidity withdrawal is the primary catalyst.
Right? Less money flowing into the system means less support for inflated asset prices.
Michael Pento sees a similar decline in housing values.
Another 40 to 50% drop. Ouch! What's driving that?
Michael Pento argues that rising interest rates are making mortgages unaffordable.
Adam Taggart also states that the rising rates leave people unable to afford their mortgages.
Adam Taggart mentions that falling home prices can hurt consumer spending.
Absolutely. People feel less wealthy and pull back on discretionary purchases.
Michael Pento adds that increased debt burdens also play a role.
Yep. When people are maxed out on credit cards, they have less wiggle room for spending.
Michael Pento suggests that the Fed is trapped between fighting inflation and triggering a recession.
He's basically saying that there are no good choices left.
Adam Taggart says that the impact of quantitative tightening on the economy cannot be ignored.
That's right. It's a delicate balancing act that could easily tip us into a downturn. Yikes.
Michael Pento emphasizes that liquidity drying up can trigger sharp declines in asset prices.
Exactly, so monitor the Fed's balance sheet and any changes in money supply metrics closely. Got it.
Adam Taggart says that falling home prices can create a negative wealth effect, reducing consumer spending.
Absolutely. Keep an eye on housing market data, new home sales, existing home inventories, and mortgage rates.
And we've reached the end of a whirlwind journey through the minds of financial experts.
Indeed, each guest from Michael Pento to George Gammon brings a unique lens on our economic landscape.
It's fascinating how they all agree that inflation is a pressing issue we can't ignore.
Right, but the nuances are where it gets really interesting, like Pento's focus on debt versus Bianco's central bank emphasis.
Plus, don't forget Jeff Snyder's point on global influences, which adds another layer to this economic puzzle.
True. And Nick Gurley's take on consumer sentiment shifting the recovery is such a fresh perspective.
These differing views really deepen our understanding of what's at stake.
Absolutely. If you found value in these insights, remember to like and subscribe.
Your engagement helps us keep delivering top-notch analysis from leading experts.
So don't miss our next video. More invaluable insights await you.
Thanks for being with us. See you next time, and be sure to check out our other great videos.